many people are now concerned that their mortgage is going to hit the trigger rate. Yes, that's right, the point where you're no longer getting ahead on your mortgage and you're getting further behind. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. All right, so welcome back. Today we're discussing the trigger rate and the trigger point and everything to do with a variable rate mortgage that has fixed payments. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And if you're in the process of looking at purchasing a home in the next little while, whether it's 3 months, 6 months, a year out, check out homebuyermasterclass.ca to get the best information with respect to buying a home in Canada in the next little while. But without further ado, let's get into it. Let's discuss the trigger rates and what all this means with respect to variable interest rates. Now, one caveat I have to make is that for the most part, if you got a mortgage through a mortgage broker in the last several years, as long as it wasn't with TD Canada Trust or TD Bank, then you probably have a variable rate mortgage with an adjustable payment, or in other words, an adjustable rate mortgage. And you're probably fine, and this video doesn't apply to you. But if you have a variable rate mortgage with one of the big banks that isn't Scotiabank, there's a very good chance that you have a fixed payment type of mortgage, and that at some point in the very near future here, if you got it basically after March of 2020, then you are going to find yourself in a situation where you are approaching the trigger rate. And that could put you in a position where you're going to start approaching the trigger point. Now, those are two different things. I'm going to explain what they mean in a second here. So let's start first and foremost with what the trigger rate is. The trigger rate is quite simply when interest rates have increased so much that your fixed payment is no longer covering both the interest and the principal. So in other words, let's say you have a $2,000 payment and you get to the point where you are now at an interest rate where your interest payment is $2,300, for example. Well, you have now crossed the trigger rate. Now, that is not to be confused with the trigger point. The trigger point is where you are starting to lose equity in your property, and it hits a certain point determined by the lender when you are in a position where you're going to have to make that up. So that, for example, would be this. If you have a conventional mortgage and your mortgage goes above 80% loan to value, or if you have an insured mortgage and you go above 105% loan to value or 105% of the value of your property, that's where you hit a trigger point. And at that point, you're going to have a couple options. You're going to have to either increase your payment substantially, you're going to have to come up with a check in order to make up for the difference, or you're going to have to convert into a fixed rate mortgage term at a higher payment in order to make sure that you get back on your original amortization. So those are the two primary concerns right now for variable rate mortgage holders with fixed payments, is that you're going to hit a trigger rate, which will eventually take you to a trigger point, and you're going to either have to get cash called, or you're going to have to convert to a fixed rate mortgage, or you're going to have to do something else drastic in order to make up for it. And all of this is compounded by the fact that even if you don't hit the trigger rate or the trigger point, you're still at renewal going to have to make up some ground because interest rates have gone up substantially. So here's the recommendations that I have. First and foremost, if you have a variable rate style mortgage, look at converting it into an adjustable rate mortgage if you want to stay variable. You can do that through a broker. By the way, if you went to a broker in the last several years and you got mortgage advice, there's a really good chance that you had a conversation about adjustable versus variable rates. And there's also a really good chance that you ended up in an adjustable rate mortgage because most of the lenders that brokers deal with deal in adjustable rate mortgages, including Scotiabank. Now, TD is the one exception to that. And there's some other credit unions and whatnot that are also exceptions to that. But if you got your mortgage through a mortgage broker and you got what you believe to be a variable rate or an adjustable rate, you probably have an adjusting payment and you're just fine. You don't have to do anything at this moment. But if you've got that fixed payment, you probably want to at least look at increasing your payments. Now, let's take a look at a couple scenarios here with respect to what could happen when we hit the trigger point. So this is put together by Dominion Lending Centers, which is the network that we belong to. This comes from an original document that was put out by TD, and it goes through the different scenarios of what would happen at certain points. So let's say you get a mortgage and you have a rate increase. So interest rate goes up by 0.5%. You've got a new variable rate mortgage, and all of a sudden your principal and interest amounts change. So in other words, more of customer A's payments now go towards interest and less towards principal reductions. Well, if you were paying attention when this all started to happen, what you would probably want to do is increase your payments to keep the amortization in line with what it should be. So in other words, if you had a 25-year mortgage and you were 2 years into it, you would have 23 years left. Because interest rates went up, your amortization would get adjusted. So you might be at 23 and a half or 24 years now because of the higher interest rate. So what you would do is adjust your payments up to get back to that 23-year amortization. Now, second rate change comes along, another 0.5% increase, 4% interest rate, and now you're paying significantly less principal and more interest. So even more of customer A's payments now go towards interest and less towards principal reduction. And again, the suggested outcome is customer A can increase the payments to maintain the same amortization schedule as laid out in the original agreement. So the gist of it is as interest rates go up, change your payments. Now, what happens if you don't change your payments? Well, that's where we get into third interest rate increase. So we're up by 0.75%. The customer is now paying 4.75%, and customer A has now exceeded the trigger rate, and his payment can no longer cover interest charged on the mortgage. So we have a $2,000 payment. That payment was fixed. We are now paying $0 in principal and $2,300 in interest. And at this point, customer A would receive a letter advising him that he has reached his trigger rate and should consider adjusting his payment or make a lump sum payment or convert to a fixed rate mortgage. If customer A continues to do nothing, he will eventually hit the trigger point. Now, what happens when you hit a trigger point? This is the trigger point column over here, payment adjustments. Customer A must increase the payment amount, make a lump sum payment, or convert to a fixed rate mortgage. Basically, he has to adjust his payments. And this is again to prevent that mortgage from ending up in a scenario where you are exceeding 80% loan to value if it is a conventional mortgage, or 105% loan to value if it is an insured mortgage. And that's the gist of it, right? We're always trying to make sure that we're putting ourselves in a position where we continue to make payments that keep us on the same amortization schedule. That's the idea. And when interest rates do increase next week with the Bank of Canada, you're going to see some people hitting that trigger rate, and they're going to have to make a decision. But they should have already made the decision to increase their payments, because just because you have a variable rate mortgage with a fixed payment doesn't mean you can ignore the increases in interest rates. So the best thing you can do again here is look at your fixed rate options, convert to an adjustable rate mortgage, or just do everything you can to get back on schedule, because that's what you need to do here. If you're in a position to pay off the mortgage in the same amount of time that you originally agreed upon, so let's say it was 25 years or 30 years, you're fine. And that's why having a variable rate mortgage with an adjustable payment is a good thing, because it makes sure that you stay on that track. And don't think just because you have a fixed rate mortgage that you're out of the woods, because at some point in the future, you are going to have a point where you are renewing and your payment is also going to adjust. So the best thing you can do is figure out what the current interest rates are now and start making adjustments to your payments as well. Because as you increase those payments, you're going to pay the mortgage off faster. And when the mortgage comes up for renewal, the impact of those rising interest rates is going to be felt significantly less than if you had left it alone. So the moral of the story here is make sure that you are paying attention. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video, and we'll see you on the very next one. Cheers.